Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello, I'm the senior trader for the Forex Super Model, and this is part 2 of Trading Psychology series, and the title is Small Account, Big Thinking. Now, in our organisation, you're judged by the size of your torch, and if you've got a large torch, you're obviously more valued than if you've got a small torch. Now, let's imagine we've got a small torch, so this is our account. Now, why is it that people trade small accounts differently from large accounts? Well, that is a fundamental question which we need to answer, because it affects how people trade and why they succeed or fail. So let's look at what's going on. So let's just head it up a minute. So small account, big thinking. So in other words, we want to basically engender a situation where people starting out with small accounts are trading them as if they had big accounts, because if you have a small account, you tend to psychologically trade in a very different way to if you had a larger account. For example, if somebody came along and gave you $500,000, pounds, euros, and said, you can do what you like with this, pay off your mortgage, whatever, buy a flash car, do what you like, or put it in your trading account. Now, you would probably treat that 500,000 very differently from if somebody gave you $5,000 or pounds or euros. So there's a tendency to undervalue small accounts by a large margin, and it's that undervaluation which creates over risk. Because what tends to happen is you say, well, I've only got, let's bring it down a notch further. Let's say I've got £1,000 account, $1,000, and I've been told that I can only risk like 1% per trade, you know, and 1% of 1,000 is $10, £10. So I like to put a pound or $1 a point on, so I've only really got 10 points, or if I'm going to go 50 cents or 50 pence, I've got 20 points, 20 point swing before I've hit my 1%. Now, bearing in mind that on Forex you're doing quite well if you get 30 to 40 points in an intraday move. So a pound or $1 a point, you're looking at $30 to $40. So $20 to $40 depending on how you're set up. Therefore, most small account holders tend to say to themselves, well, $20 is a lot of effort for $20. I spend more than $20 going down, getting a coffee and a newspaper and a packet of fags or whatever. So it's not really worth my while to put all this effort in, and to stick to the 1% rule is very annoying anyway. So they tend to say, right, well, we won't do a pound or $1 a point. We'll do $10 or a pound a point. So that $20 is 20 points is a couple £100, couple $100. Then that's more like it. But of course, what you've done there is you've traded a much higher proportion of your account, and therefore your risk is of blowing up your account is immensely increased. So that's one of the big psychological barriers to people with small accounts, is that they view it in terms of monetary amounts which they can relate to. Packet of cigarettes, cup of coffee, whatever. And really, that's what holds them back. That's one of the first things that they fall down on. So we're going to try and get away from that mindset. So we need to try and treat our small account as if it's a large account, because if we don't do that, we'll never ever get to the situation where we can move on and feel confident in trading. So that's really the first point. Now, when we're looking at so you need to say, my small account is really a large account in disguise. So that's the first psychological hurdle to get over. And also, you need to value what you have. You are not the value or size of your account. You know, there's always somebody with a bigger torch come into the room. You know, if we were managing £10 million worth of funds, somebody could walk into the room and say, well, that's chicken feed, we're managing 100 million. And if someone else could say, well, that's nothing, we're managing 1 billion or 10 billion, 100 billion. There's always somebody with a bigger account. It's the Monaco syndrome, it's the yacht syndrome. You've got all these wealthy people in Monaco, some of them with yachts in the harbour, and it's, you know, they've got a 40-foot yacht, and matey boy next to them's got a 60-foot yacht, and then someone else comes in with a 100-foot yacht, and they've got a helicopter on the back and a bigger swimming pool, and so on and so forth. And there's this constant situation where you feel, my yacht isn't big enough, or my torch isn't big enough, and therefore I am somehow inferior to the person who has the 100-foot yacht. And then the 100-foot yacht person one day wakes up and there's a 200-foot mega yacht come in. You know, it's too big to even get into Monaco, and they've got to park it or moor it offshore, and then bring in a tender to come in. So, and ultimately, that sort of psychological thinking that you're never big enough, you're always too small, your account's always inadequate, that is damaging your progress. So that's the first thing we need to get away from, that sort of, you know, my yacht's bigger than your yacht syndrome. And anyway, quite frankly, the best parties are normally on the smaller yachts anyway. Not that I would know. Right, so let's have a look at the next thing, which is probably damaging your trading. So if you're a day trader, you're a default day trader, then you're probably using some sort of structure where you've got an entry. If you're long, you've got a take profit and a stop, and it's probably based around so this is a long situation, it's probably based around ATR, average true range, for the day, on a daily. So if you're trading whatever, euro, yen or something, and the average true range is punching 100 points, 100 pips, whatever you want, and then your entries here, and you're looking for plus 40 and minus 20 on the stop, giving you a 2-to-1 risk reward, which is roughly 1% of your account size, etc. Now that is holding you back. You might think it's being sensible, and it's being you're managing your risk, and in a sense obviously you are managing risk, but it's holding you back. You're restricted. You're in this sort of range of restriction. ATR, average true range, it's just a day's range, and if you're day trading, that's where you've got to stay. So you're either doing lots of trades to try and make up ATRs which add up over the day, or you're suddenly restricted to this 20, 40, 60 point range, which is holding your whole trading growth back. Now that's a psychological problem, because that makes perfect sense. Obviously, if you're day trading, you know, there's not much you can argue with there. You know, it's managing the risk, da-da-da-da. It's what you're told to do. Great. The problem is, if you do what you're told to do, you'll get results which they want you to get. Now, the bulk of FX moves and whatever moves in financial markets don't happen in a given intraday basis. They happen over a period of 2, 3, 4, sometimes weeks. So 2, 3, 4 days. So if you're constantly chopping in and out of trades on a daily basis, because that's what you're told is the way to do it, and obviously you can't run a trade overnight, you can't run it over the weekend, you're told to go flat before big data, you know, so you take your trade out before the data, because there's going to be a headline spike up or down. Yeah, it's all very sensible, but it's actually killing your profitability and progress, and that's a psychological problem which we need to somehow overcome. Now, let's get rid of this. Now, here in our organisation, this may sound crass, but we look at three things. We look at with trading: is it fun? Is it stress-free? And is it profitable? So we want to change the metric from the default trader to these three principles. Is my trading fun? Well, it can be fun if you're charging in and out of trades, but is it stress-free? Probably not. Now, these two are very linked. Now, if you're stressed, you're probably not having fun, and if you're not stressed, you have the potential to have fun in the markets. And by fun, I'm being fairly flippant here, but nevertheless, you get the picture. So, and if we're profitable, we tend to be happier or having more fun than if we're losing money. So these principles, whilst they may seem a little bit peculiar, are actually a foundation of successful trading in our organisation. Because if you walk into a room and all the traders have got their head in their hands and they're wringing out things and snapping pencils and kicking the dog, then they're probably stressed. And if they're stressed, it's because A, they're not having fun, and B, they're probably not profitable. So you can sort of see the logic of it. Now, how do we achieve fun, stress-free, profitable trading? Well, basically we have to get control of the market rather than the market controlling us. Now, we're told that no one can control the market and that you shouldn't predict and all this. Yeah, but all very good advice. So we need to get control of the market. Control of the market. Now, by that I don't mean that we're so big that we can actually, you know, buy euro dollar and make euro dollar go up and sell euro dollar and make it go down and all this malarkey. We're not talking about control in in that sense. We're talking about it in terms of mental control, our mental control, which is very different. So if you remember, if you look at how to trade the Forex Super Model, the first, well, it's the second video, we want to be wrong, and that was where we wanted to get into this smug phase where the market was moving against us, and we were hedged, even though we thought the market was going to go up, but we wanted it to go down so that we got much better entries, and the market was actually sort of creating a situation where when we entered the market we were a lot more likely to succeed in our trade. So that was part 2 of how to trade it, how to trade the Forex Super Model. So if you're not aware of that, you might want to look that up. But so we want control of the market instead of the market controlling us. So most traders, they chuck their trade in with a stop and they've got to take profit, and then they're basically at the whim of the tides and the wind, and they're being bobbed around and thrashed around. Now we want to mentally say, well, no, we're not having that. We're gonna predict, and it's important for us to predict because, well, for one thing, if you predict, you've got a benchmark and you know where you are, and you can actually mentally go to the next level where if your prediction comes true, then your scenario starts to play out, and therefore you're more in mental control of the market. Now, so we want to predict. So psychologically speaking, we're turning the tables on the market. The market, instead of just whacking our trade around and using it as a tennis ball and chucking it out the frying pan or whatever and stomping it into the ground, and no, our trade it's a bit like the Romans used to when the legions were attacking. Now I'll use my my safety prop here. If you remember, this is our famous Forex Super Model market shield. Now, imagine, what the Romans used to do, although their shields were a different shape, obviously, they were sort of rectangular, but and they had a short sword. They recognised that if they could act as one unit and stick together and then gradually force the enemy, in this case the market, into a position where it was on the back foot, and they had short swords instead of long swords, because experience had told them that a long sword, so you've got a big swinging long sword, it opens you right up, and it wasn't really suitable for what they wanted to do. Likewise, they didn't hold their short swords like a sort of a mad dagger, because this opened them up as well. This opened up all their sides, and so they tucked in, and they had their short sword here, and they basically used the shield as an offensive weapon, and then they thrust with their short sword when the enemy was all sort of tangled up. Either had their backs against something, or they were fighting in a narrow corridor, and this basically gave the Romans local superiority. There could be 10,000 troops around them, but if they were only 1,000 strong, if they could fight the market or the enemy on a 500 basis, because the other 9,500 couldn't get at them, then they had local superiority of 2 to 1, and that is what we're trying to achieve in the market. So our psychology is of local superiority. We want to be locally superior to our, in this case, FX pair. So let's put that down. So we want local superiority. Right, so we want to be local locally superior to the market. And how can we be locally superior? Well, remember, we're only a little account in a big market. So what we have to do is we have to take mental control, and also we have to take risk control as well. So what we have to do is we have to slow the market down to our pace. And this is a bit equivalent to the Romans sucking the enemy into a narrow corridor where their main forces couldn't come to bear on a smaller Roman force. So we want to slow the market down we want to slow the market down. Now, the standard speed of the market is a tick, isn't it? So if it's euro dollar, it's a tick, a pip, whatever you want to call it. So basically, that's the speed of the market, and that's the speed of the market that the majority of traders just by default accept as the speed of the market. But it doesn't have to be that way. You can mentally slow it down and physically slow it down. So how do you do that? Well, if you go to remember, the way we do it is we have two accounts. We have a short account and a long account, and we have one unit. Say we want to be long. We have 1 unit in the short account and 1.2 units in the long account, giving us 0.2 long or 20% long exposure. And what this does is it slows the market down. So every 5 points the market goes up, we only effectively get 1 point because of the way we're set up. Yet, more importantly, every 5 points the market goes against us, we only lose 1 point. So what it does is it gives us time, and it gives us negative leverage to actually psychologically control the market. So that's what we're doing. We're psychologically taking control, we're predicting, we're doing all the things that you're told you shouldn't do, but we're doing them in a specific way. So we've slowed the market down, and we could slow it down further, but really you don't want to slow it down more than 1.2 or speed it up by 1.2, because you've got to actually make sensible profits. And our modelling has shown that a 20% long or short position is the optimum situation for buffering out when it's going against you and making enough money when it's going for you. So, and that sort of neatly brings us back to where we started. Your perception that if you have a small account, it's not worth getting $20 or whatever. Now that's where we started. So, and if we slow the market down and we do negative leverage effectively using this method, then we're actually making it even worse to a certain degree. And the market has to go up 100 points for us to make 20 points, because our points are 0.2. So 100 points plays 20. Okay, now that if we had that sort of it's hardly worth it attitude, then we wouldn't be doing that. We'd have to have much larger positions. But as I've said before, what is more important is as a trader is to actually get to the point where you know what you're doing, you've got control of the market. Remember our 3 things: you can have fun, be stress-free and profitable. And all you've got to do is gradually work up your position sizes so that you're actually achieving your $200, which you thought was reasonable maybe. But in order to do that, you're going to have 5 times the position sizes or the account sizes. Now that's where the problem starts, is that people don't want to wait or allow themselves to get to that position. But believe me, if you can, and in the process of getting your small account up to a more sizable level, you're gaining very valuable experience in the market. You're seeing how the models work, and you're actually coming on a mile. So just to summarize, we've decided that we're not going to be held hostage to the market. We're going to predict the market, and we may not be correct, which is fine. That's how we want to be. That's our smug phase in the trading. When we want to be correct, we're going to take even further control, and we're going to slow the market down to our pace, because we can. What could be better than that? So we're slowing the market down, and the market from our entry point has already dropped, and we've given ourselves a much bigger swing point on our stop. So the market has really got it cut out to do to chuck us out. It wants to spit us out. It's got to spit a lot of people out who are fully leveraged above us. So, and as we're getting away from the basic day trade philosophy, we're going into short swings, and I know that people don't like positional trades, but let's assume we do. But let's assume we're into short swings, maybe 2, 3, 4, 5 days, maybe slightly longer, depending. Then these point swings of 150, 200 points are over a number of days. Remember, the ATR is 100, maybe on average 100 points a day. So 3 lots of ATRs could be 300 points. So if you get things swinging for you, and you've slowed the market down, and you've taken control, and you've got a good entry, and the market has it all to do, you're basically, your account has become this Roman legion, and you're in the tunnel, and you've got a massive net advantage, even though you're surrounded by enemy troops all over the place. So that is the philosophy that we're using, and that's the philosophy that I would recommend you start to seriously consider, because all you're doing is really using the market process against itself, and that is as simple or as difficult as it may seem. So there you go. That's what we're up to. Look out for the next part in the trading series, which is going to take this whole philosophy a little bit further, and I hope that's been useful to you. So thank you very much.